Why is there so much debt? 10 years before the financial crisis started, individuals and families in the UK had a total of £480 billion of debt. Since then, our debt has more than doubled. But who did we borrow all this money from? Was it from an army of grannies who have spent their whole lives putting money away for a rainy day? No. When you go into a bank and borrow a large amount of money to buy a small amount of house, that money doesn't come from somebody else's savings. It's just created out of nothing by the bank with a few taps on a computer keyboard. Sounds crazy, right? But this isn't some crime of the century. It's just the way the banks work. Here's how the Bank of England describes it. When banks make loans, they create additional deposits for those that have borrowed the money. Those additional deposits are just the numbers that appear in your account, which you can use to pay for your new house. In fact, around 97% of all the money that exists is created in this way, out of nothing, when banks make loans. Every loan they make creates brand new money in the economy, whether it's a personal loan, car finance, or mortgage. Now, here's the problem. If almost all the money we use is created by banks when they make the loans, then for every pound of money, there has to be a pound of debt. If we want more money in the economy, we have to go further into debt to the banks, because more borrowing from banks means more new money is created. But the process happens in reverse when we repay loans. When we pay down our debts, the money effectively disappears. This makes it impossible for all of us to reduce our debts. If we start paying it off, then the amount of money in the economy shrinks. Less money in the economy means less spending, and less spending means fewer jobs. So there's the choice. We can have either more money and more debt, or we can have less debt and less money. When the only way to get money into the economy is to borrow it from the banks that create it, then we'll always be trapped under a mountain of debt. But it doesn't have to be this way. If we took the power to create money away from banks, and instead have money created by a public institution that isn't chasing short-term profits, then this new money, as it supports jobs and the economy, could be used to pay down the debt. And we could finally start to clear this mountain.
Bailout? Bailout? What the heck is a bailout? I can bail out my boat. I can bail out my no good brother-in-law. But what the heck is a bank bailout? Or a government bailout? These are good questions, aren't they? Because, like a very nasty infectious disease, there is a lot of this going around. To understand bailouts, first we need to understand what money is today. And that's no easy task. Not because it isn't basically simple. In fact, it is so simple, people simply don't believe it. The difficulty is that we have been taught some very dangerous make-believe and have to clear away ingrained but misleading ideas embedded in the language we use to talk about banking. Today, money is not valuable in itself like a gold coin, and it isn't just printed by the government, as the news footage would have you believe. Money is debt, all of it, even paper cash. All of it was created simply by a promise to pay it back in money. The only money that isn't created as debt is coins. The government mints coins and sells them at face value to the banks. Cash and coin are what are known as legal tender, the only real money that the courts will enforce as payment of a money debt. Despite the misleading term deposits, bank accounts are not a box at the bank where your legal tender is deposited. Bank accounts are just promises of legal tender on demand. Your bank account is an IOU, pure and simple, and an empty one at that. Bank accounts are just a record of what the bank owes you in legal tender cash if you ask for it, and most of us never do except for small amounts. All of our big transactions we do by transferring bank credit itself. In most developed countries, 97% of those bank promises are promises of legal tender that does not exist. So where does legal tender come from? It comes from the central bank of the nation. Some central banks are privately owned. Some are owned by the public. Both supply the legal tender of the nation by printing up paper cash for the cost of the printing and then using that cash to buy interest-bearing national debt at face value. Member banks have accounts at the central bank that are also legal tender on demand, but credit at the central bank is a promise of legal tender that does exist or can be printed upon request. So why do banks need bailouts? Well, because a bank loan is a promise of legal tender that the bank does not have. This promise, the bank credit, was created in exchange for the so-called borrower's promise to pay it back. This balances the bank's books. If the bank's promise of legal tender isn't returned to the bank and extinguished, the bank can't reissue this debt as a new loan. It has to stay within its risk limits and government regulations. Banks must make loans to stay in business. When money is created as debt, the economy needs a constant stream of new bank loans to prevent a disastrous crash. Why? Economists don't seem to have an answer. That's because they are oblivious to money being created as debt. They are even more oblivious to the fact that this bank credit money, once created as one debt, gets lent again as existing money. Taking these rather obvious possibilities into account, there is a very simple explanation that anyone can understand. Every dollar created as debt by a bank gets lent a second and a third time as existing money. Once paid back to the bank, that debt money no longer exists, but the second and third debts of it still do. Unless bank lending creates enough new debt money on time, the second and third borrowers will default by mathematical certainty, because the money to pay their debts does not exist. However, banks cannot force borrowers to take these loans. When borrowers refuse to borrow enough new money into existence on time, for any reason, the money supply shrinks and everyone is in danger of default and taking the banks down. Too many defaults will soon push the economy toward collapse. Therefore, when too much bank credit is not returned to the bank, and the bank is too big to let fail, the bank must be bailed out so that it can continue to make its so-called loans. The national taxpayers must go even deeper into debt, at the point of a gun actually, to create more legal tender or base money for the banks to base their promises on. But many governments are already hopelessly mired in perpetually increasing debt. And, adding to the problem, just the interest payments on this debt already exceed the willingness or ability of the taxpayers to pay it. So, to pay government debts, governments are forced to sell even more bonds. Who do they sell them to? The same banks that have no money. This system is a kind of insanity with some magic thrown in. Banks that have no money suddenly have lots of it when the government sells them bonds because it is the taxpayer debt that creates the money. Going ever further into debt to pay off past debts is like trying to escape a hole by digging deeper. Now, who can bail out a national government that can no longer sell its own sovereign debt to bondholders? Only the taxpayers of other national governments can, by selling more sovereign debt of their own. But that just puts them further into debt. In fact, because money is debt, it is quite possible for everyone to be hopelessly in debt to banks, despite the unprecedented real wealth in the world, which we, the so-called borrowers, created. The banks don't create wealth, so why are we in debt to them? The truth is that banks create money as money debt and steal real wealth with it. And for as long as this money as a promise to pay it back system continues, there will be no escape. The bankers can take everything. To comprehend how today's money system works, watch Money as Debt and Money as Debt 2 Promises Unleashed, and read up on the subject at moneyasdebt.net. There is an alternative. It is the liberated alternative people have resorted to whenever money was scarce. It was a beautifully developed local economic system in medieval markets, and with today's technology, it can be global and local at the same time. To understand the amazing potentials of adopting an entirely different concept of money, please support the author by visiting moneyasdebt.net.
Hi everybody, this is Mick Bernard back with another credit tip of the week. People call me all the time and want to talk about collections because collections, open collections, especially with balances, can weigh down your credit score. And so here's what I say about that. Be careful when you're paying off a collection, because when you pay off a collection, it sometimes updates the date of last activity on your credit report, redates that account, which means it could stay on your report for 7 more years, and you really don't want that to happen. And so when you're negotiating to pay a collection, I always encourage you to contact your collector. Do not just send in a check or make your payment because you received a letter in the mail, because you want to convince them to remove it from your credit report. Paying a collection will not make your score go up. In fact, it might make your score go down. So when you're paying those off, make sure you're getting the maximum bang for your buck, and that is make that collection company remove it altogether. If you're unable to do that, we're masters at that. Please contact us. We'll be happy to assist you with those items. As always, this is Mick Bernard. I'll be back next week with another credit tip for you guys.
Be afraid. Trillions of dollars in out-of-control debt. You know it's those liberals, Democrats, and socialists. Let's pull back the curtain and expose the little men pretending to be wizards in the land of Oz. In World War II, the debt was huge, 120% of America's annual income. But for 37 years, we held it down and grew the country, and by 1981, compared to the national income, it was its lowest in 50 years. Then it went berserk. What happened? First, in 1980, Reagan was elected based on frightening stories of out-of-control debt. He and his supply-siders came to power in 1981. And for the next 15 years, starting with their first budget, the debt spun out of control. This is more than a little fishy. Reagan had economists who saw the same graph. They knew the debt was at its best in 50 years. But they find it useful to frighten the public with the national debt. So when it's not out of control, they claim it is. And when they get the chance, they make sure it goes out of control. So who are the supply-siders? In a posh restaurant 30 steps from the New York Stock Exchange, a conservative Wall Street Journal editor engineered the creation of supply-side economics. By 1980, the supply-siders had converted Reagan, but the elder George Bush had already foreseen the future and called the supply-side prescription voodoo economics. Reagan promised he would reduce the debt faster than anyone. We won't hold him to that, but he should not have raised it faster than our income was growing. The green line shows the debt staying at a constant percent of income. The red line shows he didn't come close. So he blamed Congress, but over his 8 years, Congress appropriated less than he requested. Clinton reduced the debt. Then Bush came in, saw the budget surpluses, and promised to retire nearly $1 trillion in debt, the largest debt reduction ever achieved by any nation at any time. Like Reagan, Bush had no idea what his supply-siders were up to, and they relaunched the debt with his first budget. So, what did the supply-siders invest in with the $9.2 trillion they borrowed? America's future? No way. The money bought tax cuts for the very rich and for corporations. We have nothing to show for it. Voodoo is about Wall Street, not about Main Street. Some debt is still left from World War II, and most is from the supply-siders. But Obama is no supply-sider, so why is the debt still going up? It's hard to stop a runaway budget. Reagan got it backwards, Bush Sr. tried and failed, and it took Clinton 3 years to turn it around. But there's more bad news. Borrowing in good times leaves you trapped in bad times. To reduce the debt, raise taxes and spend less. To reduce unemployment, lower taxes and buy more. Nothing works for both. But would a real patriot let the government borrow and spend in bad times? Let's look back at some tough times to see what Uncle Sam was doing when everyone loved him. After 11 years of the Great Depression, the government finally started spending big on war goods bought from industry. So Uncle Sam borrowed the equivalent of $10.5 trillion in 5 years. And here's what happened. Patriots bought war bonds to help Uncle Sam borrow more. Industry hired Rosie the Riveter and millions more. The Great Depression ended and the country's output doubled. Then we won World War II. And after all that borrowing, Uncle Sam paid down the debt until, yes, of course, until the voodoo started. Supply-siders raised the debt 20 out of 20 years. That can't be just bad luck. Truman, Eisenhower, Kennedy, LBJ, Nixon, Ford, Carter, and Clinton all reduced it. But now, as in the Depression, the path to greatness requires putting America back to work. And the generation that gave 400,000 lives for their country is the generation that showed us how. That was patriotism.
There you were, chilling out, young and carefree. Life was good. Until... Tuition fees! Increase! What were you to do? There was no way you could afford the increase in fees and the living costs. Or could you?
Firstly, you don't need to pay anything straight away. You'll get a loan for your fees and your living costs, which you don't need to pay back until you're earning over £21,000. So, say you're earning £22,000, then you will pay back 9% of your income above £21,000. Or, to put it another way, £7.50 a month. About the cost of a small takeaway pizza or a trip to the cinema. If your salary is £25,000, you'll pay £30 a month. About the cost of a mobile phone contract. In fact, under the new loan system, students are £540 better off every year than students on the previous scheme, with more money in their pocket. Your repayment comes out of your paycheck each month before it even gets to you, just like tax. But we're not going to sugarcoat it for you. Depending on what you earn, you could be paying more money back for longer, perhaps most of your working life. However, after 30 years, your debt will get written off. Most people will never have to pay off the full amount, and the repayment scheme is designed to be affordable. You'll be charged interest on your loan from the moment you take it out. But the amount you pay back each month won't be affected by the interest. You'll only need to pay back 9% of your income over £21,000. Plus, this debt isn't considered in your credit rating, which helps when applying for mortgages and credit cards. You can also view it as an investment, as graduates earn on average of £12,000 a year more than non-graduates over their working life, according to the Office for National Statistics 2011. So, can you afford to go to university? Well, that's up to you. Going to university is a big decision. Weigh up the pros and cons and make a choice that is right for you. The task force would like to thank Bournemouth University for the use of their video. The legal stuff. The information in this video is based on the most recent figures published by the government at the time of production. The Independent Task Force on Student Finance Information and Bournemouth University have taken every care to ensure that the information is accurate, but we cannot be held liable for its accuracy. You should take advice based on your own personal circumstances before entering into any financial commitment. Produced September 2011.
This is the VOA Special English Economics Report. Businesses are structured in different ways to meet different needs. The simplest form of business is called an individual or sole proprietorship. The proprietor owns all of the property of the business and is responsible for everything. For legal purposes, with this kind of business, the owner and the company are the same. This means the proprietor gets to keep all of the profits of the business, but must also pay any debts. Another kind of business is the partnership. Two or more people go into business together. An agreement is usually needed to decide how much of the partnership each person controls. One kind of partnership is called a limited liability partnership. These have full partners and limited partners. Limited partners may not share as much in the profits, but they also have less responsibility for the business. Doctors, lawyers, and accountants often form partnerships to share their risks and profits. A husband and wife can form a business partnership together. Partnerships exist only for as long as the owners remain alive. The same is true of individual proprietorships. But corporations are designed to have an unlimited lifetime. A corporation is the most complex kind of business organization. Corporations can sell stock as a way to raise money. Stock represents shares of ownership in a company. Investors who buy stock can trade their shares or keep them as long as the company is in business. A company might use some of its earnings to pay dividends as a reward to shareholders. Or the company might reinvest the money back into the business. If shares lose value, investors can lose all of the money they paid for their stock. But shareholders are not responsible for the debts of the corporation. A corporation is recognized as an entity, its own legal being, separate from its owners. A board of directors controls corporate policies. The directors appoint top company officers. The directors might or might not hold shares in the corporation. Corporations can have a few major shareholders, or ownership can be spread among the general public. But not all corporations are traditional businesses that sell stock. Some nonprofit groups are also organized as corporations. For VOA Special English, I'm Mario Ritter. You can learn more about business and economics and find activities to learn English at voaspecialenglish.com. We're also on Facebook, Twitter, and YouTube at VOA Learning English.
Did anybody get taught this at school? No? Has anybody used it since? No. The guys putting their hands up are probably engineers. I've only ever used it once to build a rabbit hutch. Did anybody ever get taught about these at school? No. They didn't exist when I was. Has anybody actually used them? Pretty much everybody. So I mean, like, fundamental facts about the way money works isn't taught at school. And it's even deeper than simply knowing how to get the best deal on a credit card or on your mortgage. It stretches right to the depth of where money actually comes from. That's what we're going to talk about for the rest of the day. Okay, so firstly, who creates money? Where we are today, obviously, I mean, everybody knows these are created by the Bank of England, by the government. It says on there, the clues on the note. But actually, this type of money now only makes up 3% of all the money in the economy. So what's the rest of it? The other 97% is just numbers in a computer system. Nothing else. So where did this other 97% of all the money come from? Well, this is Martin Wolf, the chief economics editor of the Financial Times. The essence of the contemporary monetary system is the creation of money out of nothing by private banks, often foolish lending. You couldn't really sum it up any more succinctly. Creation of money out of nothing by private banks, often foolish lending. Okay. Some people aren't totally convinced by this. So we have some quotes from the Bank of England. The money creating sector in the United Kingdom consists of resident banks, including the Bank of England, and building societies. Money creating sector? I mean, most people know that if you try and print your own 10 or 20 pound notes at home, the police are going to come through your door at 2 a.m. the next morning. So how come there's this money creating sector that includes banks and building societies? Here we go. When banks make loans, they create additional bank deposits for those that have borrowed the money. Okay. Paul Tucker, the second in command at the Bank of England. Banks make loans by simply increasing the borrowing customer's current account. That is, banks make loans by creating money. By far, the largest role in creating broad money is played by the banking sector. When banks make loans, they create additional deposits for those that have borrowed the money. Anybody still doubtful? Well, if you were still doubtful, here's a letter from the Bank of England that one of our supporters wrote in with some questions. He said, when a commercial bank makes a loan to a borrower, does a commercial bank in effect create new money? In other words, when a bank makes a loan to a borrower, is that money just created out of thin air? And they just responded, when banks make loans, commercial banks do indeed create much of the money in the economy. So effectively, we have almost a fully privatized money system where all the money that we are using is created by private banks out of nothing when they make loans. So this is where we are. Very few people understand this. Banks create money. All the evidence is there. It's not a conspiracy. It's just fact. It's just the way it works. So how much money do they create? Okay. Well, the key question here should be who decides? Who decides how much money they're going to create? If you walk into a bank tomorrow and ask for a loan, you're going to have to discuss this with a mortgage advisor or one of the bank tellers who are going to help you see if you can actually afford that loan. So these guys at the bottom are deciding whether to make loans to people. And every bank loan creates new money. So these people are actually deciding whether to create money. They probably don't know it, because most people at the bottom of a bank won't really understand the way the system works. And let's look at the incentives that these guys have. So, you're working in the bank, you're on a fairly modest salary, but you also get bonuses for every every loan that you make. You get a commission. That's your incentive. So you have this decision when you're working in the bank. Either you lend or you don't lend. Okay. And if you lend, you can get a commission. You get that bonus at the end of the year if you've hit all your targets. You get to keep your job. And you have this opportunity of getting promoted if you're performing well. If you don't lend, well, there's absolutely no benefit. There's no rewards for bankers that don't lend. And if you consistently don't lend, then you get fired. So when the incentives stack up like that, what are you going to do? You're going to lend. Okay. So when somebody comes in asking for £1 million mortgage on a house that they can barely afford, but you know that you're going to get potentially a 10 grand bonus for actually sealing the deal on that mortgage, then your incentive is to lend them the money. You're not going to worry about the money supply of the economy or the bigger economic issues. So these guys are creating money every time they make a loan. They don't necessarily realize that they're doing it, and the entire sales culture is driving them to lend as much as possible, which is basically blowing up the money supply as quickly as possible. These corporations are creating money, and it's systematically set up so that they're always going to try and inflate the money supply and create as much as possible. The guys at the top, they maybe understand that it is creating money, but they don't ever consider the impact that will have on the economy. And when you look at banks the size of RBS, HBOS relative to the UK economy, the fact that they don't consider their impact on the economy and how that might feed back, that's scary. So how much money have they actually created? Well, the cash, physical cash, currently adds up to about £57 billion, which, to put it into perspective, is about 19 Richard Bransons, or enough to buy 351,000 houses. The electronic money that the banks create, there we go. And this is perfectly to scale. £2,200 billion, which is 733 Richard Bransons, 13.5 million houses. To put that last number in perspective, it's basically enough money to buy half of all the houses in the UK. There's only about 22 million houses in the UK. And you can break this down by year as well. This is all from Bank of England figures. So in the 90s, they were creating an average of about 40 to 50 billion pounds of new money every single year. And then in 2000 onwards, it started to increase. We got 68, 66, 98 billion pounds of new money pumped into the system in 2004. And then it really gets out of control. And this is your house price bubble. This is why houses were getting more expensive. And then we had the credit crunch, and they stopped creating new money. Because we were so dependent on debt by that point, that's when the economy really started to grind to a halt. Put this into perspective, in 2006, 171 billion pounds of new money created, adds up to about 3,800 per adult in the UK. Again, Professor Charles Goodhart, the supply of money is actually determined primarily by the demand of borrowers to take out loans. So if we're willing to keep taking on the debt, then the money supply will expand. And if you have banks with incentives, as we've seen, then the money supply will expand. We would add one other thing to that statement, which is that it also depends on how confident the banks are. If they're confident that the economy is going to be good, they'll keep lending. If they're panicking, then they'll refuse to lend. So I mean, basically, the money supply, which is the foundation of the economy, depends on the mood swings of bankers. What do the banks do with the money? Well, this is the fairy tale of banking, which you still hear in the press and you still hear in economics undergraduate courses. Banks take money from savers like my grandmother, like anybody who's saving up for their pension, and they then go and invest it in businesses, and that helps the economy grow, and it creates jobs, and it means, we all get richer as a result. So, two types of lending that a bank can do. There's productive lending into things that will actually grow the productive capacity of the economy. Now, this is not productive in this sense, doesn't mean that the loan's going to be repaid or that it was a wise decision to make the loan. It means that it will actually increase the amount of stuff and services that we can produce as an economy. And then there's the non-productive lending, which is things like housing, things like speculating in the financial markets. This doesn't actually increase how much stuff we have. It doesn't create new houses, it just makes existing houses more expensive. So we're going to do a quick quiz. Okay, what percentage of bank lending do you think goes to business? 50%, 22%, 8%, or 75%? 8. This is absolutely correct. 8% of bank lending goes to productive businesses. Good. The other thing as well is that all that unproductive lending, all this property and speculation lending, doesn't add anything to growth. So when you hear about the economy's in recession, we declined 0.1% last year, or we've grown by 0.1%, which actually I think means that somebody found a fiver down the back of the settee and spent it. Well, none of the bank lending that goes into unproductive lending will increase growth. Only this here will actually increase growth. Only that will actually really create good jobs that aren't, just pure speculation. Okay, so this is what they do with the money they create. They pump a lot of it into housing. We'll hear a lot more about this afternoon, but this is what average house prices have done since 1952 when my grandparents bought a house. The average house back then was about £1,800. It's now about £188,000 and rising again. So why is there this bias against lending to businesses? Well, think about it. You're a bank. You can lend on a property. And if that property loan goes bad, if the person doesn't repay you, you can repossess a property. Now, if you lend to a business, there's usually very little that you can repossess. I mean, if it's a sandwich shop, there may be a bit of equipment there. If it's a service business, the chances are there's absolutely no real physical assets that you can repossess and sell. So the risk on a business loan is much higher. There's also the Basel Capital Accords, which build in, without going into the details, they give banks a systematic bias towards lending for property. Makes it more expensive to lend to businesses. There's also the fact that your average business loan might be 30 to 100,000. Your average mortgage these days is going to be 188 to $250,000. So it costs even more administration to make a loan to a business. Going through the business plan, speaking to them, see if they know what they're doing. Whereas with the housing loans, a lot of it's automated. So the actual cost of arranging that loan is much lower for the property. So basically, banks are systematically biased towards lending for property. And this is really quite a fundamental problem because the capitalist system, the idea is that money will flow to productive businesses. And actually what we've got now is a system where the banking sector actually doesn't want to lend to the productive part of the economy. And that's going to lead to the system collapsing. So this is why you have so much unemployment, so much joblessness, because banks just don't invest in productive business. Only 8% of it goes into that. The other 92% goes into the gambling and speculating that's blown up the economy and led to all this unemployment. Okay, so the three key answers to those three key questions that we had before. It's banks that create money. They create up to about £266 billion a year, although it's about £100 billion a year at the moment. And they pump most of it into property bubbles and speculation. So this is how far we are away from the textbook model of banking. Okay, so the consequences. Firstly, it means that when we allow banks to create all our money through lending as they do at the moment, it means that the entire money supply is effectively on loan from the banks. So basically, we have to get all this money from the banks by going into debt to them, and then we have to pay interest on all of that back to the banks. So we're effectively, between all of us as members of the public, we're paying interest on every single pound in the economy, pretty much. But we're basically renting the currency from the banking sector. This is really a privatized currency. More importantly, it means that if banks don't lend, then there will be no money in the economy. And there's another implication of this. If we all start paying down the debt, as David Cameron advised us to do the other day, it means that the money supply will start shrinking. There'll be less money in the economy. That's going to be a big problem. If there's less money, it's like sucking the lifeblood out of the system, and people start losing their jobs, the economy slows down, and we have a recession, as we have right now. This system and all the incentives that we've seen earlier leads to the boom-bust cycle. It's nothing to do with the psychology of businesses or anything. It's all to do with banks pumping up these bubbles and then panicking and refusing to lend. I mean, this is really a house built on sand. The banks start off by lending more into the economy. And that kind of stimulates the economy and encourages people to spend more because they've got more access to credit. At least people are more confident of their income, their job's doing well. They might get a pay rise because the economy's speeding up. They think, I can afford to take on some more debt. I'll get a house that's £1 million mortgage instead of £500,000. That means everybody ends up owing more, and then sooner or later, some of those people won't be able to keep making these repayments on an ever larger amount of debt. So they start defaulting. And then we've got the defaults, we've got less lending, the banks are panicking, people are still repaying their debts if they can do, so the money supply is shrinking. That leads to less spending, and that leads to your recession. This is your boom-bust cycle. Banks expanding the money supply and then panicking and shrinking it again. We're never going to have a stable economy if we have this kind of money system. And this is why every 5 or 7 years there's a recession that throws, millions of people out of work. It's completely unnecessary if you had a stable money supply that wasn't under the control of the banks. Also, when you have a recession, then people lose their jobs, they have to go on to unemployment benefit. Also, businesses are making less profit, so they're paying less in tax. So basically, the government revenue falls below what it was when they were almost breaking even. And when it falls, you're basically faced with the choice of, do we fire all the police? Do we close down all the hospitals and the schools? Well, no, we're not going to do that, so we need to borrow more add it to the national debt, basically. So this is what we have with the national debt. Now it's currently about £20,000 per person. And given another few years, we'll be looking at about £35,000 per person. And the impact this has for you is that your interest on the national debt, your share of the interest on the national debt, is about £81 a month. So you're paying this tax that you thought was for schools and hospitals, and it's going directly into the financial markets. As another consequence as well, it means that if you want to get out of debt, the only way you can do it pretty much is by getting money from people who have the money. Which basically means if you want to get out of debt, you've got to push somebody further into debt. You want to get your head above the water, then somebody else has got to go deeper underneath. So this redistribution from the real economy to the financial sector, because all the real economy, the businesses, shops, factories need to borrow the money supply from the banks, and they've got to pay interest on it. Sorry, a lot of the businesses that are talking about not being able to borrow now, they're not trying to borrow because they need money to expand, because they don't really have any customers that have got any money to spend. They're trying to borrow money so that they can stay in business and not go bust. It's a cash flow issue. It's not about growing the economy. So even what the government's talking about getting banks lending to business again, it's not going to do anything. It's going to stop a few of them going bust, but it's not going to grow the economy. You've got to get money to consumers and to people who are actually going to spend it. We'll talk more about that later. So this redistribution from the rest of the UK back to the city, because Scotland, Wales, the south west, the north all need money to actually function, Northern Ireland, and they are redistributing this money. They're paying interest on all the money supply back to pretty much the city where the highest paid people are concentrated. So that's a redistribution from the periphery back to the centre. Okay. It's a parasite. Okay, so it's a major democratic issue as well. I mean, this is, on the left you have government spending between 2002 and 2007, a total of £2.1 trillion. And on the right you have total bank lending in that time, £2.9 trillion. Now this is all the money that the banks are allocating into the economy, and they are deciding whether it can be used for productive enterprise, for growing businesses, or whether it should be used for blowing up property bubbles or speculating in the financial markets. So they actually have more spending power than the government itself, which in itself is a real democratic deficit that we should be worried about. But it gets worse, because these 5 banks have 80% market share. So they effectively control around about 85% of the money in the UK economy. And these 5 banks are run by boards. The key decision makers are the guys on the boards of each of these banks. There are only 78 board members across all of these 5 largest banks. And I don't know if you know much about how boards work, but there's generally a lot of fillers who are there for their credibility and supposed expertise, but who aren't key decision makers. I mean, usually the key decision making team might be between 8 and 15 people. Particularly at the big banks, you get your core team there. So basically, we potentially have given, in the region of probably about 30 to 40 people, control over more money than the entire government has spent in 7 years. And that's a real reason to be scared. You know, this is, these guys are steering and controlling the economy. And we need to get some of that power back, and we'll talk about how we do that later on. So, you know, all of this is leading to the situation where we have Mervyn King saying that of all the many ways of organizing banking, the worst is one we have today. And, you know, we couldn't agree with him more.